I spent time building a business, and that business was real estate investing. I figured, hey, the quickest way for me to get out of this job and start making money actively as a business owner looks to be real estate. So I got involved in that.
This is the Multifamily Journey Podcast, show 28.
You're listening to the Multifamily Journey Podcast. In this show, you'll hear industry experts share tips of success and failure from their real estate investing journeys. You'll get a transparent look behind the curtain while you learn to fulfill the lifestyle you want to live and achieve your wealth goals. Get ready for the journey to financial freedom through investing in multifamily real estate. Here's your host, Blake Dailey.
What's going on, everybody? Welcome back to the Multifamily Journey Podcast. It's great to have you back for another show. And as always, it is a blast for me to record these and bring these interviews to you guys. And it's been so much fun. And today is a very real estate related show, but the topic is not real estate investing. Though we have the guest, David, he used to invest in real estate. He started flipping houses. In 2 years, flipped 50 houses. And you hear on the show, he got that start by paying for a coaching program and getting around the right people. And now is taking that into his current business, which is whole life insurance, or as you've probably heard about it, called as infinite banking. So we dig all into infinite banking, how it can be a great resource and financial strategy for people. It's something that me and my wife have thought about, well, mostly for me and my wife, about how we can get started with it and really set up our family for the future to come. You can have one in your name and your spouse's name and your kids' names and really build up generational wealth for your family. And we talk in the show today, like this is how the rich families set up generational wealth. This is what the Rockefellers do. And there's a great book called What Would the Rockefellers Do that talks about this exact strategy. So David and his company and his team provide this as a vehicle for people to grow their wealth. And what I learned from David in this episode, it's basically a savings account. You borrow from it and can go out and invest, buy real estate, do deals, whatever. And then the cash value keeps growing. So you keep making interest. And as you pay it back, it just keeps growing over time and you keep contributing to it. So super cool strategy, something to have in, your back pocket, something to think about as you build and grow and scale your portfolio. So today's a really good show. But before we get into that, I wanted to mention a revamped kind of multifamilyjourney.com website. So by the time this airs, there's going to be all new resources on the site, revamped, additional updated information. You can download those for free. We got an active investor toolkit, a passive investor toolkit, and then just a getting started toolkit, finding your market, analyzing deals, talking to brokers, getting started, that kind of stuff. It's all free. That's going to be updated on the site by the time this airs. And those are just free resources to help you get started on your journey as a way for me to provide value. I don't sell any products. I don't have anything to sell. It's literally just trying to help. And then finally, if you guys like the show, please leave a rating and review. Does a lot to help get the show out there and keep getting good guests. So I appreciate that. And that is all I have. So with that, let's get into the show. David, welcome to the show. It's good to have you.
Yeah, thanks for having me, Blake. Appreciate it, man. My youngest son's name is Blake, so you got that going for you.
Very nice. Yeah, this is a double coincidence here. I think you're the first Air Force Academy grad that I've had on the show. So I've had Army, freaking West Point, and then Naval Academy grad, so the lesser schools. So I finally got equal in the world.
Yeah, finally somebody I don't have to make fun of.
Yeah, there we go. Right? Both gold caps. So this will be fun. Yeah, this will be good. So just for those listening, why don't you give people a little bit about yourself? I know your journey isn't entirely real estate, but there's some intertwined in there. And then the topic we're going to get to, I think, will be a good little mix to throw into the show as well.
Yeah, you bet. Well, much like you, I went straight to the Air Force Academy, graduated there in 2003, went on to fly for the Air Force for about the next 12 years, and then did my last 2 years in the Air Force active duty, attached to an Army unit out of Kansas. So after about 12 years in the Air Force, decided, you know what, I want more control over my life. And you'll see as we talk, control is a really big theme to me, which is what led me to what I do now professionally. But got out, tried corporate America for a couple of years, 2.5 actually, and realized after the first year, this is not for me. So for that next year and a half, that I spent in corporate America, I spent time building a business, and that business was real estate investing. I figured, hey, the quickest way for me to get out of this job and start making money actively as a business owner looks to be real estate. So I got involved in that. I partnered up with a guy out of Colorado. We met at a mastermind out in California in 2017, actually 2016.
Which mastermind?
It was a 7-figure flipping mastermind. I think Bill Allen runs that now.
Yeah, I went to that one in 2019. It's good.
Yeah. Great group of guys and gals. But yeah, I met a guy out there. We started talking, working together a little bit, and then we partnered up here in the Twin Cities. I live in Minneapolis right now. And we did mostly wholesaling, but then we got into the flips the second year we were in business, and we did about 50 deals in that first 2 years that we were business partners, and then kind of reevaluated what I really wanted to do in life, what really gave me some fulfillment. And it turned out it wasn't flipping for me. It wasn't wholesaling. And I realized there was really only 2 things that I ever enjoyed talking about and had a lot of passion around, and I could talk about for hours. And one was flying. So I decided to get back into flying. So I'm a commercial airline pilot right now. That's more of a part-time job, really. And the other thing was infinite banking, which is what I'm here to talk to you about today. But I was like, man, I talk about this all the time to so many people. I've been doing it since 2010.
So you're already doing this. You're doing this yourself while real estate investing. So you had the experience of just investing your own money into it, right?
Yeah, absolutely. So I've been doing this since 2010 is when I started my infinite banking process and created my own family bank, a series of them actually. And I talked to another practitioner, a guy named Tom Lonnie, who's brilliant. In fact, he works alongside Bill Allen at his mastermind groups. And
coincidentally enough, that's like where I first kind of found out about this strategy was from Tom.
Yeah. Tom's phenomenal. He knows his stuff, and I've spent a lot of time with him recently, actually. And when I decided to go into this business, I spent some time with him, and he just gave me like an hour and a half of his time and told me everything he thought I should know going in, and I did it. So I've been doing this as a business for about 2 years now.
Yeah, I think that's super valuable there. Like when you can find somebody that's doing it, and especially when you find somebody doing what you want to do, and to get their time. So, I mean, can you just talk to that a little bit? Like what do you think made him just give away his time like that to help you? Was it anything you did specifically?
I think you find that a lot in this arena, in the real estate world, and then in the infinite banking concept practitioner world, especially. You find people who are they're very knowledgeable, and they're very willing to just reach out and help somebody else who shows some motivation and some ambition to get to where they are. I mean, people will take you under their wing as long as you show them that you do have, in my case with Tom, he and I met at a Costa Rica mastermind trip, and we sat by the pool for like 2 hours, maybe 3 hours one night, late at night, just talking about infinite banking, and money and, economy and that kind of stuff. So I reached out to him, and, he saw my passion for it, and he's happy to. In fact, he and I just split a case on somebody else from that mastermind group, another real estate investor and land developer. We just closed a case on him together. So I needed Tom's help on that one, and he's got all the answers. So he really helped me along with using a new company to set this guy up with his own policies. So
yeah, that's great. I think that's 100% true. It takes a little bit of ambition and competence, because if you could have all the excitement in the world, but you got to bring a little bit too, and add to the conversation like you guys did by the pool and all that stuff. But I think the path you took into this space is really unique, because you were already doing it right before you just started the business. You had known about investing in it. You've seen what it was doing for your family. You had this involvement in real estate, which everybody that I know invests in whole life has been brought to it through real estate. So can you speak to, I mean, it seems like you did the same thing. So can you speak to why those two industries tie so well together before we get into, what is infinite banking and all that?
Well, I would say the reason those two industries mesh so well together is because real estate investors know how to think outside the box. So you're not stovepiped into just a traditional mindset and way of thinking. Like it takes courage to step out of, what everybody else does, which is their 401k and, et cetera. doing what the mainstream does and listening to all the CFPs out there telling you what to do with your money, and to venture into real estate where, your reward is based on how much how educated you are, and, the due diligence you put into a deal beforehand.
Yeah. I feel like I'm always putting together like a puzzle, taking all the pieces and trying to put square pegs in the round holes and just making it work.
Yeah. That's the same thing with this business, because there's so many ways to design a strategy for somebody that it's never a one size fits all. It's never just a carbon copy from one client to another of, hey, here's a policy for you. Here's your bank. Go off and prosper. No, it's completely different every time. And that's what we are. We're problem solvers. So that's what you do in real estate. You get paid to solve problems. And that's how I get paid in this business too, is to solve problems for people and help them accelerate the growth of their capital and find opportunities.
Yeah, that's great. I think this would be a good transition into, how you help those people. I guess, first of all, let's just back up. Let's start out by, what is infinite banking? And then we can go from there. Cause I think we need the more context before we build on this.
Yeah, no, perfect. That's a great place to start. So what is infinite banking? The infinite banking concept, and I'll call it IBC throughout our conversation here. It's all about controlling the financing and the banking function in your own life. We finance everything we buy, right? Would you agree that we either pay cash or get financing when we purchase something? Yeah. So those are the two options that we've been taught to do, right? And, if you go get financing, obviously you're paying interest to some outside institution, a bank usually. If you pay cash, what people usually don't think about is you lose the opportunity to earn interest on those dollars for the rest of your life, right? So, hey, save up $20,000, go buy a car. Well, you exchange that cash for a car, but now you've lost the opportunity for that $20,000 to work for you for the rest of your life. What we do with infinite banking is combine the two. So we combine saving and using debt to build your wealth. So what is it? It's really infinite banking. The vehicle that's used for this process, this concept, is whole life insurance, but it's specially designed whole life insurance. So it's not like the kind, if you just call up, Northwest or, whatever, some big insurance company and say, hey, I want a whole life policy and I want some cash value in there. It's not going to be designed correctly, most likely. It's a specially designed policy that is really built to accelerate that cash value growth inside the policy so that you can build your capital, you get guaranteed growth. And then once you have capital, have you ever heard the quote, when you have money, opportunity will find you?
Oh yeah.
Like that is absolutely true. And I've witnessed that, firsthand multiple times. When you have capital,
I hear it all the time. Like when more experienced investors or just those that have been investing for longer, they talk about the last downturn, right? And those with capital or access to capital back then were able to make, huge leaps and bounds in their portfolio because real estate was so cheap. And those that didn't, or maybe they did a little bit, they wish they had more capital when the opportunities were there.
Right.
Yeah.
Right. And people who had capital maybe bought a lot of GameStop stock a week or two ago, right?
Yeah. Funny enough, I had another academy grad I knew that put in a small amount of money, but got up to like 1.3 million off of GameStop. He's like, oh, this is going to the moon. I'm staying in.
Oh, that's crazy.
And then on that Monday that it dropped, he lost like 900,000 or $1 million. And that like is the volatility of the stock market and exactly why I don't even mess with it right now. And I just solely real estate, and why you probably choose safer options like whole life insurance as well.
Absolutely. And I think you even used the word investment earlier, and that's such a common misnomer when people talk whole life insurance. It's not an investment. So that's one of the biggest things I like to get out to people is life insurance is not an investment. I never use insurance and investment in the same sentence unless I'm saying they're not the same thing. Whole life insurance is savings. Really, the only thing you can compare it to is a savings account. It is the best place. If it's properly designed, it's the best place you can grow your capital and have access to it at the same time. So really, it's an asset. The way I think about it is before I spend any of my money, I want to funnel it through this asset first and then leverage the line of credit that asset provides me to go invest, to go purchase. So it's not like, I can either put money in life insurance or I can invest. No, I put my money in life insurance first and then I invest. You do both. You do everything.
Okay. So going back to what you're saying about what is infant banking and how it works, and based on what you're just saying there, let me try to summarize this and see if I got a good grasp on it for those listening. So basically you open up your whole life insurance policy, you become the bank, you put your money, you save your money in this whole life policy. It begins to grow over time. And then as time goes on, as soon as you open that policy, you can take out the cash value amount and invest it. The whole life policy keeps growing in value. Your money is out working for you here to get you, the higher return, whatever it is you invest in, real estate, other assets, and then you bring it back and it continues to grow. But at some point you got to pay it off, right?
Yeah. So it's very close, and you may understand it, but I just want to clarify, when you build that cash value inside the policy and you access it, you're not actually touching your cash value. Your cash value, once $1's in there, it will never leave. In fact, it'll stay in there forever, earning uninterrupted compound growth for life. What you actually get is a line of credit from a different pot of money, from the insurance company's pot of money, to borrow from them, and they collateralize your death benefit for that. So they know they're going to get paid back.
Mm-hmm. So it just means that, like, if you die somewhere in there, they're just taking out that amount you invested out of your cash settlement of your death benefit.
Right. They'll take your death benefit. They'll subtract any loans, any outstanding loans you have, and then they'll pay the rest of it to your beneficiaries. Exactly.
Gotcha. So if you're using it, say you're flipping houses, you're using it to purchase the house, you're selling it, putting it back, and you just keep recycling it. The whole life policy is growing the whole time, and if all the money is there when you eventually do pass away, then that whole sum just gets paid to your family, or whatever the difference is of what's out and what's in.
Yeah. Yeah. So whatever your death benefit is at that time, and your death benefit will rise every single year too, with the way these are designed. So you may start with $500,000 right now. I mean, at your age, man, if you started now, by the time you're my age, I'm 41, you'd probably turn that $500,000 into a couple million in death benefit. So that grows alongside your cash value every single year.
So I hear all the time that, and I think there's a book written about this too, is like, what would the Rockefellers do? And this is what they used largely to preserve, what the Rockefeller family did to preserve their family wealth and build that, generational wealth and legacy, like so many people want to do, right? They kind of see that as the peak of where they could get if they had generational wealth, is like the Rockefeller family, the Carnegie family, a big name family like that, the Ford family. So typically, I mean, when you think about it, this is like what rich families do. This is an investment vehicle only the rich can invest in. So is that true, or can you dispel that? Like, can a person that doesn't have, millions or billions of dollars invest in these?
Yeah. Again, you keep saying the word investment, but to me, in this business, and when I was flying too, when I was flying A-10s in the Air Force, words have meaning to me. So I'm very, very particular when I talk to people. Like, I want you to understand it as well as me. Now it's going to take a while because I've been studying this for years. Yeah. So to get back to the Rockefeller thing, as I understand the Rockefeller method, and I've read that book, great book, what they do, every new Rockefeller that's born, a whole life insurance policy is purchased on them, and it's held by a trust, the family trust. So every time a Rockefeller dies, that death benefit gets paid out to the trust. I mean, they'll never run out of money. It's almost literally impossible for them to run out of money, but they've created their own family bank. Well, they'll never need to go to a commercial bank to get a loan. They can go to the family trust, get a loan. And if they don't pay it back, well, guess what? When they die, the trust is going to get paid back anyway. It's a generational thing. And just think, Blake, if your dad or your grandfather had done this, what if your grandfather had done this for your dad, and then your dad did this for you? I don't know if your grandfather's still alive, but maybe your great grandfather, because this has been around for over 250 years. So this is one of those strategies that the wealthy have used. Banks use it, big corporations use it, and they've used it for hundreds of years, but you don't have to be wealthy to use it. I was in the Air Force. I was a captain in the Air Force when I started my first 4 policies. So you don't need a lot of money to get started. You just need to get started.
So this is something that everybody has access to, it sounds like. And I think, with your company and others like it, there's something noble about, creating these opportunities for ordinary people to have these extraordinary, benefits down the road. So I really like that. And I'm asking these questions because I'm very interested in it as well as, my wife and I think about planning our family. I'm thinking, if we have kids, I want to do something like this so that just the Dailey family begins to create generational wealth from them. So this is something I've talked about in my mastermind groups, and I wanted to have you on the show because it's something I'm genuinely interested in. And, hopefully through that, the questions that I'm answering can help other people that might not know what it is at all. Like, at least I have a little bit of background about it. So I appreciate you sharing everything as we go.
Yeah. Well, and you bring up kids. I mean, I've got a policy. I've got 3 sons, and I've got a policy on each one of them. I don't put money into a 529 college savings plan. I could go on and on about, the restrictions that those have compared to what a properly structured whole life, dividend paying whole life insurance policy has. They don't even compare. So my thought is I'll fund their college if they want to go to college, if they end up going that direction through these policies. And then they can take the loans, pay for college, or, and maybe at 20 years old, they decide I want to start a small computer company, drop out of college, start a computer company with a loan for my life insurance policy, and, become business owners and multimillionaires. Who knows?
Yeah.
And Walt
Get
Disney
that control back. Like
did it. JCPenney did it. Yeah.
Take it into their own hands.
Yeah, exactly. I feel like I want to go back to explaining this in a better metaphor for real estate investors. So are you familiar with what a HELOC is? A home equity line of credit.
Yeah.
So
I have one open right now, actually. Just waiting.
Good. Yeah. It's a great tool. So what infinite banking is, it's kind of like a HELOC. So if you have a house, you have a mortgage, and every month you make a payment, a monthly mortgage payment, and part of that payment goes towards equity in your house, right? Now, once you get enough equity built up, you can go to the bank and request a home equity line of credit. And what they'll do is, if they grant that to you, which they don't have to, and a lot of them stopped doing that a year ago when COVID happened, but they can grant you access to that equity inside your home that then you can use to go do whatever you want to do, invest, spend. Some people make stupid decisions like go buy a new boat with it. But if you use it smartly, use smart credit smartly, you can do really well using that. Well, anyway, infinite banking is a lot. It's very similar in that every month or annually, if you pay your premium annually, a large portion, the majority of that premium payment goes towards equity inside your policy. And you build that equity up over time. Distinct differences, though, between infinite banking and a HELOC. With infinite banking, you own and you control it. So that policy is in your name. Like, you own it, you control it, you tell it what to do. It's guaranteed to always increase too. So unlike your home, which maybe 2007, 8, 9, if you had a HELOC out, your home lost value, all of a sudden you're underwater. So there's no guarantees.
Yeah, and this is something I wanted to ask too, because when I first heard of infinite banking, like my natural, radar went up. I was like, oh, that's a Ponzi scheme. Like, nothing's guaranteed. But then as I've learned more about it, I've just become more open to it and, not so closed-minded. So can you just speak to how, that guaranteed aspect of how it keeps growing no matter what the market is? Because I think that's a big allure to this strategy.
Yeah, absolutely. Real quick, the third big distinction between infinite banking and HELOC is there's no required repayments. So there's no repayment structure. You don't have to pay those loans back. Obviously, you should. You don't have to. Not like the bank is going to come knocking on your door and maybe take your house if you don't pay the HELOC back. Not so with IBC. So there are guarantees out there, and guarantees come with insurance. So when you deposit your money into a bank, what do you get in return? Guaranteed? What's that?
The interest rate.
Okay. But what guarantee do you get? What do they always say? FDIC insurance.
Yeah, I was going to say that, like the
right?
FDIC insurance, where it's, even if the bank collapses, you still get paid.
Right. So that's insurance. So that's your guarantee. Now we could talk about FDIC and how they only have 1%, enough money to cover 1% of all deposits in the country. So it's basically useless. But we won't go there. But insurance contracts have guarantees, and it's written out in black and white. So every time I work with somebody and we get to the point where we design a policy for them, we walk through that policy and I show you the left-hand ledger, which shows your guarantees. So at this year, all you have to do is pay your premium. as long as you pay your premium, there are guarantees every single year saying your cash value will be this amount at a minimum, and your death benefit will be this amount at a minimum, guaranteed. And then the right hand side of the ledger shows your non-guaranteed returns. Now, non-guaranteed includes dividends. So dividends that's another word for profit, right? I partner with insurance companies that have been around for 100 to 170 years plus, and they have 100+ year track record of paying dividends out every single year. So imagine that they were paying dividends out during World War I, during the Great Depression, during World War II, during the 70s, during the 80s, 2008, they paid dividends because they were profitable. And guess who got those dividend payments? The policy owners, because they're mutually owned companies, meaning me as a policy owner, I'm a part owner of that company. So I am first in line to receive profit from the company. So, and those numbers grow much faster than the guaranteed numbers. So I like to call that, in an Army term, most likely course of action from my Army days. So you've got the guaranteed course of action and the most likely course of action, which is going to look better than the guaranteed. But there's guarantees, man. And insurance provides guarantees.
Okay. Yeah. That's really interesting. And I think that's a good explanation to think, people have their money in all these different assets, and you talk about diversifying, but some people just diversify in different stocks, but not in these different asset classes that have different benefits than just being in like the equities market. So I think just as you talk through this more, it's starting to make more and more sense to me, to at least open one for myself and test it out, and maybe for my wife too. But one thing I wanted to do for everybody listening is, could we go through an example of starting a whole life policy, or maybe like once you've got it started and then drawing out to do a real estate deal, because you've done both. So drawing out to do a real estate deal, and then what that whole process looks like so people can wrap their heads around it.
Yeah. The process, a lot of people, when they start learning about this, they think, oh, well, that's just so complicated. It sounds like a lot of management, like very detailed. And the truth is, it's very, very simple. And you could talk to any of my clients and they tell you the same, where we take what's difficult and complex and bring it down to something that's easy. So the process, well, I'll tell you my process. First, I'm not going to work with anybody unless they're educated. So you may walk into, some financial planning place off the street. Do they really care how educated you are on stocks and investing?
No, usually they just want to take your money.
They want to take your money, right? They're like, don't worry about it. You just go work your 9 to 5. Give me your money. And when you turn 65, don't pay attention to it. But when you turn 65, I'll start releasing it back to you in little increments.
And I think that's such a problem with financial planning too, because just like you're saying with the education, if you never learn, if you never get educated about it, you're going to get to 65 and realize you just made like a 4 or 5% return over the last 30 or 40 years. And now you don't have the retirement savings you expected because you didn't do the upfront education required.
Exactly. People work 40, 50, 60 hours a week to make money, but they won't invest 1 hour a week to learn how to keep money.
Yeah, to keep and grow, which is like the most important
absolutely
part of it, or else you're just going to be working to pay your bills. And I don't know. I don't think that's any kind of life to live,
No. And you're lucky to have, figured that out so young and so early on. But so the first step is always education, man. I tell them, hey, read this book, Becoming Your Own Banker by R. Nelson Nash. That's like the original Infinite Banking.
Yeah, isn't he like the OG of Infinite Banking?
He's the OG. He's the godfather.
Yeah, he used to just like do in-person seminars before technology was the thing.
I mean, the guy's brilliant, and he's on a different level. He was, he passed about 2 years ago. I did have the pleasure and the blessing of meeting him like 2 or 3 months before he passed, but that was really cool. But he wrote the book in 2000. But the cool thing is he'd been using the concept for 30 years before he even wrote the book on it. But since he wrote the book, we've really gained a gathering of a following of people who are really, we're like infinite banking evangelists. Like I told you, I was telling people about this for 10 years before I ever decided to actually make a business out of it. If I can make money doing it, then I can benefit more people. So educated. If somebody's not willing to read a book, a 92-page book that'll take them 2.5 hours to read, then I'm not going to work with them. So read a book, come to me, we'll talk, we have a conversation. Then the next step is run the application to find out if you can be insured. Life insurance is the only financial product on the planet that you actually have to qualify for. So you got to make sure that you're an insurable.
Out of curiosity, like I do have several investors and several people who listen to this podcast that are in the military. They fly, they're deploying to combat zones, different things like that. Does that make you less insurable when you're in one of those career fields?
So my very first client was an active duty Army pilot. He's one of my best friends now, and he's actually an infinite banking practitioner as well, doing the same business as me. But he got a policy on himself. That there are some things at the time of the application is really the only thing that matters. It's a snapshot in time. So when you take the application, if you have orders to deploy to a combat zone, you'll probably get denied. If you don't have orders to deploy, but you're pretty sure, maybe a year or two from now you will, it doesn't matter. If you don't have any orders in hand to deploy, then you put no, I don't have any orders to deploy, and you're good to go on the application.
Yeah, that's good to know.
So it may be a little tougher sometimes, but my first client, like I said, he's a full-time Army. He's active duty Army still, and he's got 30 clients, and most of them are Army. So it can be done. It's not a big deal.
I think I took us off track with the side questions, but
no worries.
Somebody
back to the process. So educate, make sure you're insurable, and then we create a detailed strategy for you, put it into effect, execute it, and then you start capitalizing it. You start capitalizing your bank. That's what I call it. It's like your personal bank. You start capitalizing it, and once you get the capital up and you have an opportunity, because what this does for you is it makes you a smarter investor. That's what I found in myself, that now I've got all this money. Like sometimes I may have had like $30,000 sitting in a checking account, like twiddling my thumbs, like, oh man, I got to get rid of this. I got to find something to do with this. I need an investment, or else I'm just going to go buy a new truck.
Yeah, I found myself in the same boat, actually about to buy a boat. And I was like, no, it's probably not the best idea.
Yeah. But if you put that money here first, now you got time. It's building for you. It's earning for you while it's in there. Right. So you don't have to jump on the first thing that comes across your plate. You can actually go out and do the due diligence. And guess what? You'll start seeing opportunities because you're looking for them. Like, that, like you wouldn't see any apartment opportunities if you weren't actively looking for them. If you didn't have your eyes open, your subconscious is looking in the background.
That's a very good point. It's hard to find what you're not looking for. And then it's like the, confirmation bias or whatever. And then you start looking for those opportunities and you see them everywhere. You start to see more deals to analyze, more investment opportunities once you're ready and take that step. I've seen that for sure.
Exactly. It's that old analogy of, you really want to go buy a white Ford Bronco. Well, then all of a sudden,
Broncos everywhere.
Oh, that's before your time. But all of a sudden, every other car you see on the highway is a white Ford Bronco. You
probably had this in between junior and senior year at the academy when they give you that big, nice cadet loan, and you go out and buy the car, and then you start seeing that car truck everywhere. I know this happened to me.
Exactly.
I
wish I could have that loan back, a 1% loan.
I know.
But
mine was 0.75% interest, 36,000 at 0.75.
Yeah.
Did not use it super wise. I did max out my Roth IRA for that year. Bought my wife a ring, and then bought the truck.
Isn't that what every cadet does? Buy their girlfriend a ring.
Yeah. Hey, we worked out though. She's right. I'll keep her around a little bit longer.
Yeah, keep her. She wasn't your sponsor's daughter, was she?
No.
Yeah. Oh, anyway, off topic again, but you capitalize that. You find an opportunity, and then it's as simple as I log into my account, I click, I want a $25,000 loan. Like 2 to 3 days later, typically, I'd give myself a week. That money shows up into my bank account, and then I can go write a check for whatever opportunity that I have pegged.
That's good. It seems very simple. In that, are there fees? Is this wired to your bank account or pay like an origination fee for that you're paying yourself?
There are zero origination fees. There's zero fees whatsoever, other than what's on that illustration that we look at.
Mm-hmm.
You'll see what your guaranteed numbers are.
Let's talk about that. Just to get to that point, what kind of contribution is required? I'm sure it varies depending on what kind of policy, but like typically, what kind of contribution are you looking at in that first year and then ongoing every year thereafter?
Yeah, well, we usually set it up so it's the same amount every year.
Okay.
So I like to use round numbers, so say $10,000 every year. There is a strategy I like to use in the first year where you can actually dump in a whole lot more than that right away in that first year to really accelerate your cash value growth. So that's one of my favorite strategies. But I like to tell people you should be able to put 10% of your gross income towards something like this, right? Because that's what ideally you'd be able to save anyway.
Yeah.
So if you're going to save it,
the whole Robert Kiyosaki thing, pay yourself first, go directly into savings and then to investments and then to paying your bills.
right? Too many people start contributing to a 401k and they don't even have an emergency fund. They don't even have $2,000 in the bank account. So what happens when they put their money in the 401k? It's all locked up. They're earning who knows what. Like the last few years, it's been great. What's it going to be this year? I don't know. But over the course of a lifetime, they say it averages 10% in air quotes there. That doesn't account for fees and doesn't account for taxes.
Yeah.
So what's that number really? A lot lower than 10. But so they're putting their money there to earn, say, 5% on it. And then something comes along and they don't have any money. So they go to the bank or they use their credit card and borrow at 15 or 20%. It makes no sense whatsoever.
Yeah. The spread on that's awful.
Yeah. So you're not going to win the financial game, the money game, if you can't save. If you don't have the discipline to save, in my opinion, you're not going to win any game.
Yeah.
There's nothing that's going to
that comes
work
like
for you.
that ties back to real estate directly. Like if you're looking at your profit and loss statement, or you're running numbers on your properties, and you're not like accounting, or maybe you are accounting for capex and maintenance and stuff like that, but if you're not actually taking that money out and setting it in the business savings account or the savings account for that property, then you're taking withdrawals or whatever, treating that as income, where really that's an expense that over time it's going to happen. So if you can't learn to save, it's just not going to be clean for sure. And I figured this out once I got a bookkeeper and accountant. So
yeah, that's what Nelson Nash would call stealing the peas. Says don't steal the peas. So a great analogy about a supermarket owner in there taking his own groceries home without paying for them. Well, he's stealing the peas and he's going to ruin his business by doing that. So you got to play honest banker with yourself. Yeah. So anything you take out, any loans you take out, you really want to treat that like you took a loan from a commercial bank. Commercial bank is going to charge you interest. So when you want to pay yourself interest at least equal to what the bank would charge you. So you can set up, people do different repayment structures. I always recommend repaying it, but it doesn't have to be on any certain timeline. Some people might,
and that's a good point to break out a little bit. So when you say you take out $50,000 to go put it on down payment as a house, and say you do the BRRRR strategy, and then you get that $50,000 back at the end, do you recommend, or is the common strategy to just put that $50,000 back? Or if you're paying 5% to the bank, would you pay the $50,000 plus 5% back to the policy?
Yeah. So I would absolutely pay that back into my policy and refill that hole in the ground. So I like to use that analogy of, I had one client who was a real estate investor. He does a lot of flips. He had about $100,000 just sitting in his bank account, waiting to be used to fund his next flip, to fund the rehab.
Money to inflation.
Yeah. So it's just sitting there earning nothing for him. And in fact, he may have even been paying private investors an interest rate on the money he was borrowing from them in order to go use on a flip that he may not actually use that money for 3, 4, 5 months. We actually moved all 100,000 into a policy right away. And then he immediately started taking loans against his policy to go do his flips. But what really excited him about that is that when he sells those houses, every time you sell a flip, hopefully you get a big chunk of change, right? You get a big payday.
Hopefully,
you need somewhere to,
when it works that well.
Yeah. But you need somewhere to put that. Well, now he's got somewhere safe, somewhere secured, somewhere guaranteed, somewhere where it's protected and where it's liquid, that he can just refill that hole in the ground that he's dug for himself from those loans, fill it all the way back up, and then, fill his line of credit all the way up to the top and wait for the next opportunity for the next flip.
Yeah, that's good. And another question I want to ask is, when it's sitting in there, what kind of return can somebody expect to get from these policies?
Yeah, it's a good question. Over the course of your lifetime, you'll get 3 to 5% on average.
Still a lot better than sitting in a bank account for.
Well, and it's tax free. So if you consider taxes, that's a great thing about this is it grows technically tax deferred, but the way the way I train somebody to use it, and any infinite banking practitioner would train somebody to use it, you'll be able to access that line of credit tax-free for the rest of your life, even the growth.
Mm-hmm. So everything that grows within the policy is tax-free. Obviously, when you loan to yourself and make investments outside of the policy, that gets taxed at, your income or whatever level. But as you put it back in, it's not taxed there. Correct?
Right. So yeah, it's good for everybody. Everybody's first question, especially real estate investors, their question is, well, how do I get tax deductible money into the policy? Well, you're really going to fund these policies with after-tax money. But once it's in there, it's never going to be taxed again.
Tax-free. Okay.
That's the great thing.
Yeah.
So it grows
really good.
Essentially, yeah, you can access it tax-free. And then when you die, because you will die someday, and as long as you have permanent life insurance in place, like whole life, like we're talking about, it will be there when you die, no matter what age you die at.
This could really be like a flipper's best friend. Because, you talk about pulling out of a self-directed Roth or a solo 401k, something like that. If that's your own, you can't invest in your own deals typically.
Right.
Invest in somebody else's. But if you have this policy, it's growing tax deferred, likely at a lower rate, but still 3 to 5%. You're beating the banks, and it's your money that you can lend to yourself.
Exactly. You nailed it. I think I've talked to a lot of people who flip and they put their money into like 30-day CDs or, money market accounts or something like that, which earn better than the bank, but not much. Here, you're going to earn 3 to 5% tax free. And when you die, like I said, you're going to die. You're going to get a death benefit. Your beneficiaries will receive a death benefit payout, income tax free. And that payout could be millions and millions of dollars. So talk about
even when you pass away, what gets passed to your family is passed tax free.
Yeah, the death benefit is income tax free.
Wow, that's really powerful. And does that have to go into? Do you have to go put that in a family trust, or does that get paid out just by your will? Or
yeah, there's different methods. It gets added to your estate. So I think I'm not a CPA or a tax attorney, but there are possibilities of it increasing your estate over a threshold to where now part of your estate gets taxed, whatever that threshold is. It changes every couple of years, I think.
Yeah. I think it's like 11 million or something, which is.
Yeah. I think 11 million is what came to mind. So as long as your estate's under that, your death benefit will be transferred income tax free to your heirs. So, how nice would that have been for you? If a grandfather, great grandfather died and left you something.
Past, 10.5 million tax free. That'd have been real. Yeah, nice.
You could
probably have a lot more properties right now.
Yeah, you would. You'd have a lot more friends too.
Yeah, that's good stuff. Yes, that's really good. Just to think about, the longevity of this savings account, so that you can go invest out of it. Another thing before we transition here, the last segment, there's 2 questions I want to kind of hit before we get there. Is what's the difference of someone starting now like me who's 24 as opposed to someone who's starting later in life like 45 or 50 or somebody there's a 20-year time gap?
The biggest difference is the cost of insurance. So every year you get older, you get closer to mortality, right? So as you get closer to mortality, it's a bigger risk for the insurance company. So the cost of insurance goes up. Mm-hmm. I think my youngest client was 23. When he became a client, my oldest client is 62, and everything.
Yeah, those are going to see big differences, I would assume.
Yeah, big differences, and they have different strategies. So the older client wanted more of a death benefit because he's closer to mortality. He wants to leave something for his kids and his grandkids. The young client, 23, bulletproof, invincible, a pilot, never going to die. He didn't care about death benefit.
Yeah, I share that sentiment, I think.
Yeah, right?
Yeah,
I'm still there.
No, that's good. So, you're talking about getting more for your money when you're younger, as opposed to waiting, or, if you're already older listening to this.
Yeah. Well, and you just have more time to see this thing grow, because with every single year, it becomes more efficient. Like, it's guaranteed to become more efficient, and there's nothing you can do about it. It's kind of like flying an airplane. You take off and you weigh 10,000 pounds. Well, for every single mile, you're burning
fuel, getting lighter.
Several pounds of fuel, right? So an hour later, now you weigh 9,000 pounds. You're more efficient, and there's nothing you can do about it.
Yeah. And I like these Air Force analogies. We gotta keep these coming. And
oh man, I got plenty of these flying analogies. That's
bring them back into
bread and butter. Yeah,
I like it. That's good. And the last thing I kind of wanted to hit on here is there Well, I know there is, but like, what's the benefit of setting this up for your family like the Rockefellers do? I mean, we can even use me an example talking about me and my wife. Like, do we open up a policy for us as a family, or do we open one up for both of our names, and contribute, say if we have $10,000, do we invest $5,000 in each, or is it better to just start with one and put the 10,000 there and plan on putting 10,000 a year?
Yeah. Well, the answer to that is going to be, it depends, but only one person can be insured for each policy, right? And then there can be one owner. So typically I recommend, if it's all the same to the family, I like the main breadwinner to be the one with the most death benefit, right? Because they've got the most, they're bringing in the most, so they need the most replacement value for their life.
Mm-hmm.
So definitely getting a policy on the breadwinner. And then I would go to the non-breadwinner, the other spouse, because I mean, even if you got a wife who stays at home with kids, that's a big job. And I'd imagine that's a very expensive job to have replaced if something ever happened to the wife. Right. But that's all on a case by case basis. Like I said at the beginning, there's no one size fits all. It's really what are your goals? What are you trying to accomplish here? And then we figure it out from there. So it's a series of policies as well. So you don't have to have just one. You have one now. A few years later, you get a pay raise, you make captain, and you take that pay raise and you open another policy on yourself and start funding that one. Then you make major, you open another policy and start funding that one. So you can have a series of policies on yourself. I think Nelson had 40 or 50 policies on himself at one point.
Wow. Yeah, that was kind of going to lead into my next question, because I know you said that, or at least at one point you had 4 policies. Can you give us an idea of what your family is, like wife and how many kids, and then the policies for that family, like the cumulative policy, just to kind of like, so we can wrap our head around it?
Yeah. So when I first started, because I couldn't actually get one on myself when I was in the Air Force in 2010. I think it's probably because I was flying, or maybe I had a deployment.
A dangerous life.
I was living in the
Top
danger
Gun
zone.
said, no way are we insuring this guy.
Yeah, I know, right? I forgot the quote I wanted to use there, but
it was something Air Force related.
Making decisions is my body can't cash.
Yeah.
So we ended up getting one on, I had 2 sons at the time and my wife at the time. So I got 3 policies. And then when my 3rd son was born a year later, I got one on him right away. The younger you get them, the cheaper they are. And the more they're going to accelerate. My youngest son, he got one when he was 1 year old. So when he's 40, when he's my age, he will have had that policy for his entire life, and it'll be unbelievably efficient. Like every $1 he puts in there will probably yield him $3 in cash value. Like it's crazy. So that was my journey. And then when I got out of the Air Force, I got a job in corporate America, and I was going to get this bonus. And I was like, well, that's a big bonus. I'm going to get that every year. Why don't I just put that entire bonus into a policy? So I started one. It was like my bonus policy. So I talked to a lot of military Air Force pilots who, after your 10th year of your commitment,
the sign-up bonus,
they start throwing $25,000, $30,000 at you a year to keep you. I turned that down, but I have a lot of friends who kept it, and they're getting close to retirement now, just a couple years away, and they're getting that $30,000 a year. So I've got a couple clients who that's their policy. They take their bonus, dump it into the premium every year. And when they retire, they'll use half of their retirement income to fund their premium, because they should not be using that retirement pension to live off of as soon as they retire. Mm-hmm. I think too many guys do that. They don't go out and get their market value. Like you need to
don't get another gig, and then you're getting,
don't consider that retirement pension like
streams. Yeah. It's like,
yeah, you should be using that for retirement. So put that whole thing away. You shouldn't live off of it. Not for several years at least. So so different strategies for different people.
That's all really good stuff. I appreciate you sharing that and what you did with your own family, just so we can kind of get an idea of it, maybe for those out there with families, their possibilities. And for me as well, kind of thinking through these own things with getting to start my family. But with that, let's get into the last section of the show here. This is the
Fortune 5.
All right, David, this is the Fortune 5, the 5 questions I ask every guest, every show. So kicking it off, what's the biggest thing that has contributed to your success?
And the biggest thing that's contributed to my success has been to be coachable. I've always had a coach, whether it's sports or business, just being open to learning from other people. Like you said at the beginning, man, that it's amazing to put yourself around people who know more than you, who've been where you are and who are where you want to be. So that, and then being open-minded. So
yeah, that's really good. Can you expand on the business coach a little bit? Cause this is something I've thought about. And I played football at the academy, so I'm used to just always having a coach. So you play football at the academy?
I did until I tore my ACL and then I hung it up.
Oh man, so many commonalities here.
Yeah, I know, right?
That's awesome. What position?
Receiver.
Oh, one of the offensive guys.
I was fast, but I couldn't catch. Didn't work out too well.
It sounds like you would have been better at track than
Yeah, probably.
Yeah, that's good. But yeah, just back to the business coaching thing.
Yeah, the business coaching, I mean, it makes sense, doesn't it? Like if you want to be good at basketball, you need a coach.
Yep.
If you want to be good at whatever, but so many people don't even think about, well, I should get a business coach. Like there's no shortcuts in life, right? Except there are when you have a coach who knows,
been there, done that,
who's been there and done that and can save you hours and hours and probably years of trial and error. They can just show you the way. So, I mean, that's why my business partner and I joined that real estate mastermind group immediately.
Mm-hmm.
And we paid a lot of money to be in that group, but it was worth every penny.
Yeah, it helps you flatten your learning curve. Like you were saying, you guys did 50 deals in 2 years. That's like consistently 2 deals a month over that time period. That's a lot more than your average flipper. That's for sure. It's probably large credit to getting around those kind of people. Yeah, I just bring that up because that's something I've thought about getting here more recently as my portfolio is starting to grow a little bit and thinking about making it more of a business, because as you get bigger, it really does turn into a business, right? And everybody preaches passive income through real estate, and it is, and it can be, but you have to put the systems in place and create the business.
It's a lot of work.
Make it passive. Yeah, it absolutely is.
There are ways to do it passively, which is nice, where you just take some money, give it to a syndicator and sit back and reap the rewards. But you still have to do the due diligence and educate yourself and make sure.
Yeah, which is like a big perk of the people that invest in my deals is they don't want to do everything I do because they see me working, 90 hours a week. I'm sure you've been the same at points in building your business. It's a big fallacy, right? Like all those multifamily courses or, real estate flipping courses, you can flip houses or buy multifamily properties by just picking up your phone, but then they pass over the 5 years of work it took to get there. But I mean, absolutely passive investors come into these real estate deals, and it's just knowing the difference. So I try to educate people on that stuff too and make that distinction. But good stuff. All right. Second question here. What's been the biggest mistake so far that's turned into a learning lesson for you?
Man, every mistake turns into a learning lesson. I like that. I like the motto. You don't fail if you learn a lesson. But the biggest mistake, so the one that always pops into my mind, it's a funny one. It's an entertaining one too. And I doubt you'll have somebody on the show who's made a bigger mistake or done something like this before.
I love when this question starts this way.
You want to know what my biggest mistake was in business? I hired a bank robber. Like, no kidding.
What?
A legitimate bank robber. So she was fantastic too. I even had her taking checks to the bank and depositing them for us. But so it turns out a couple of weeks after we hired her, I spent all this time training her up. My business partner sent me an email and he's like, check this out. I clicked on the link. I opened up a news article and it's a picture of her wearing sunglasses, leaving a bank like 3 or 4 years earlier. Right. And it said her name in bold letters. Apparently she robbed like 5 banks in 2 different states and did 3 years in prison. And she was young. And we hired her. So what I learned from that is I need to institute a little thing called a background check.
Yeah. How did it turn out? Was she fired or did she end up,
man. So I got on the
from you breaking to the
I got on the phone with my attorney right away. I was like, hey man, can I get rid of her? He's like, yeah, the state you live in, you can fire anybody for any reason as long as, you're not keeping somebody else who's also a felon and not firing them too. And then he emailed me something, but he emailed it to the wrong account. It was like a business account where she had access to it too. So she saw this email from my attorney and she wrote me, she's like, what's this about? So I was like, well, time for us to have a phone call. So yeah, we just fired her and never heard from her again.
Yeah, before she ran out with all the loot.
Yeah, right.
I've never heard that when I hired a bank robber.
Yeah, I didn't even think bank robbers still existed.
Yeah, I think the last one I've heard is like Chris Voss, who wrote Never Split the Difference. He's like with the bank robbers, but that was even like when he was the head of FBI in like the 90s. I don't know.
Yeah, but hey, do you know why people rob banks?
Like banks get robbed every day, but that's actually the first time I've heard of.
Yeah, I know. That. I've never met one in person, but do you know why people rob banks?
What's that?
Because that's where the money is.
That's a good point.
Like, it's called Willie Sutton's Law, and Nelson talks about it in his book. Actually, wherever there's money, people will try to steal it.
Yeah, I know that's why a lot of businesses like won't accept cash, right? They'll just do e-payments or whatever so that they can't get robbed.
Yeah, and there's also a little thing called the war on cash, but that's a different topic.
Yeah, different topic for
government trying to get rid of cash.
Speaking of books, hey, this is a good transition point. What's your favorite book that you'd recommend for someone starting out? And real estate, infinite banking, anything, your number one book.
Yeah, I mean, I got a favorite book for every area of life, but for infinite banking, it's for sure either Becoming Your Own Banker by Nelson Nash, or it's The Case for IBC by Carlos Lara and Robert Murphy, and Nelson Nash as well. Those are the best two books, and those are the two I recommend to anybody before we start talking.
Awesome. What's your favorite life book out of curiosity?
Man, my favorite life book. Well, the Bible for sure. Always got that one, but my favorite one on just life in general. Oh, you know what? One of my favorite books that I had to really dig into in 2018 because I was getting really stressed out about running my own business and everything that comes with that. I'm sure you can attest to that. I read Dale Carnegie's How to Stop Worrying and Start Living. I would highly recommend that book to anybody. Everybody's heard of Dale Carnegie, How to Win Friends and Influence People.
Yep. But I thought that's where you're going to go with it, but yeah.
Yeah, I know. But you've never heard this one, which is a phenomenal book. And it gives you like practical steps you can take to stop stressing out about decisions you have to make. So How to Stop Worrying and Start Living. I've read it twice. That's a great book.
That's a good one. I'll have to check it out.
I mean, I think there's probably not a person out there that doesn't have anxiety or stress at some level. So that's a good book for anybody.
Yeah, not in today's world. Too much going on.
Yep.
That's a good one. Hey, next question. What do you do for fun outside of your business?
Man, I got 3 boys. They're 9, 11, and 13. So I got 2 hockey players. In fact, we're leaving for hockey practice in about an hour and a half. Awesome. A late hockey practice on a Wednesday night. 2 hockey players and a basketball player. I coach basketball. I've been doing that for a few years now because I don't know how to skate, so I can't coach hockey.
Because you couldn't teach him how to catch the football. So
yeah, right.
You had to teach him a difference for him.
I know how to throw the football, but I wasn't good enough to play quarterback at the zoo. Yeah. So we do stuff outside. I just hang out with the boys, man. Any free time I get, and I've been trying to get involved in the local community. Join the Lions Club here, so I'm just trying to become part of the community as well, and actually do some volunteering, which I've been saying for years and years I need to do, but I'm finally doing it this year.
That's awesome. Love it. Yeah, I'm actually with some other officers here locally going to go help Habitat for Humanity here pretty soon. So
that's cool.
Fun. Same thing, get more involved, and that's good stuff. Love all that. And last question here, David, where can people find out more about you and connect with you?
You can find me Facebook, LinkedIn, YouTube. I got a bunch of videos out there on YouTube. In fact, some good ones I usually point people to before we start talking about infinite banking that really just simplifies the whole thing. And then my website, maxperformancefinancial.com. You get on there, you can check the resources tab, and there's a training video series you can sign up for. It's like an hour, maybe less than an hour long. So it'll give you a good head start on what this is all about if you want to learn more.
That's good stuff. I appreciate it. Well, awesome. Thanks for coming on the show and sharing. This is a kind of diversion from the normal real estate topics, but I think super applicable to those looking for a way to get more efficiency out of their own capital and build it to be able to use it for whatever, and just, generational planning. Because I think that's what brings so many people into real estate is, wanting to set up a solid financial future, not only for themselves, but for their families or for their family. And look at the most successful family doing that of all time, the Rockefellers, and what do they use?
Right.
Infinite banking. So that's awesome. This has been really good, David. Thanks so much for coming on the show.
Yeah, absolutely. My pleasure, man. Thanks,
all right, and we're out of here.
Hey, thanks for listening. If you like the show, if you found value in it, please go to iTunes and leave a rating and review. And if you want to check out more on your multifamily journey, go to multifamilyjourney.com where you can get free resources to start your journey and figure out your path. That's multifamilyjourney.com. But more importantly, go take action today towards your financial future. See you next time.